And in our top business story, the UAE will cut spending this year for the first time in 13 years, as low oil prices lead the government to take major action by reducing energy subsidies, according to the first official breakdown of the government's spending plans for the year. While the country has huge reserves, it is adopting a more cautious fiscal stance. Consolidated government spending, including the federal government and the UAE's 7 individual emirates, is expected to drop to 460.6 billion dirhams in 2015 from 480.8 billion dirhams in 2014. This would follow several years in which spending increased at rates of close to 10%. The central bank said that its projections were based on a study by the International Monetary Fund, which sent a mission to the UAE in May and June. The projections show the rise in government spending on employee compensation sharply slowing down, with such spending to increase only 3.4% in 2015 to 48.8 billion dirhams. The government expects to save money with big cuts in subsidies, projected to fall 34% to 13.0 billion dirhams, and grants down 48% to 11.3 billion dirhams. Meanwhile, low oil prices are expected to slash consolidated government revenue by 22%, leaving a fiscal deficit of 30.6 billion dirhams, or 2.4% of gross domestic product. The IMF stated that it would be the UAE's first deficit since 2009. Despite the spending cuts, the central bank predicted economic growth would stay strong. It forecast 4.0% growth in 2015, down only moderately from 4.6% last year. The Dubai Land Department has released figures that show that the total amount of real estate transactions in Dubai exceeded 129 billion dirhams in the first half of the year. The government department stated that it saw 23,000 transactions during the first 6 months of the year, with the total value of transactions for the whole of 2014 recorded at 218 billion dirhams. Its H1 report revealed that sales accounted for 53 billion dirhams of the deals, while mortgages accounted for more than 65 billion dirhams. For unit sales, Business Bay came in first, with the value of its transactions reaching 2.5 billion dirhams, while for mortgages or of units, Dubai Marina was the top area, with deals totaling 1 billion dirhams. Sales and mortgages relating to land transactions recorded more than 106 billion dirhams from 8,240 transactions, with commercial lands already built on representing the lion's share in terms of value for the type of land, with 47% of the total. The report said that Al Yafra 2 area of Dubai was revealed to be the most attractive for sales transactions, while the value of deals reaching 2 billion dirhams. For mortgages, Al Barsha South 1 or Al Barsha South 1 came in first through 348 transactions worth 360 million dirhams. And over to Abu Dhabi, the demand for office space remained flat during the second quarter of the year as depressed oil prices continue to impact the market. In a new report, Jones Lang LaSalle said that the decline in oil prices directly impacted the oil-related sector and indirectly impacted other sectors due to a slowdown in government spending. Large-scale requirements continued to be driven by the government sector and state-owned enterprises, with the bulk of private sector demand focused on smaller offices suites. JLL said that the total office stock in the UAE capital reached approximately 3.2 million square meters gross leasable area in Q2, with the delivery of new space at Masdar City, Abu Dhabi International Airport, and Capital Center, adding 48,000 square meters. In spite of weak demand, Grade A office rents have remained stable due to minimal vacancies, with Grade A stock with average Grade A and B office rents remaining at 1,730 dirhams per square meter and 1,180 dirhams per square meter respectively. About 54,000 square meters of retail space is expected to enter the market by the end of 2015, largely as non-mall retail within mixed-use developments. DP World Limited has announced that it handled 30.6 million 20-foot equivalent units across its global portfolio of container terminals during the first half of 2015. In a statement, the company added that gross container volumes also grew by 4.1% on a like-for-like basis, and on a reported basis, gross volumes grew by 4.2%. According to DP World, the growth in the first half was largely driven by Europe and UAE terminals. The UAE delivered another solid performance, handling 7.9 million TEU, which represents growth of 6.0%. Europe continued to show steady growth despite the difficult geopolitical environment, and the Asia-Pacific and the Indian subcontinent region delivered an improved performance in the second quarter, with a recent capacity addition at Nhava Sheva in India to provide further room for growth, according to the company. DP World stated that the performance in the Americas and Australia region has been broadly flat due to soft economic conditions. DP World's portfolio of consolidated terminals handled 14.4 million TEU during the first half of 2015, a 3.5% improvement when compared with the same period last year. On a like-for-like basis, consolidated volumes also increased 3.5%.